Hi there, I'm Alex Verge, CEO and founder of Journey Energy. If you've been following this series, you already know we're in the middle of a major strategic shift. Today, Journey produces about 11,000 BOEs a day, but we're not just another conventional E&P company. Together with AIMCO and our directors, we own about 32% of the business. Over the past 12 months, I've been actively increasing my own ownership stake in the company, which now sits at around 7%. That kind of alignment ensures that we think differently about value, risk, and long-term growth. It's a marathon, not a sprint. There's no better example of that mindset than our journey into the Duvernay. In this video, we'll talk about our history in the play, our perseverance through adversity, our willingness to stick with it when the odds are stacked against us. Our Duvernay story started back in 2016. At the time, Journey had just completed the acquisition of its initial position in the Gilby area near Rimbey, Alberta. This acquisition included legacy Hoadley Glauconite, liquids-rich gas production, and a piece of the 104 gas plant. Through mapping and through technical studies of the Duvernay reservoir properties, we believed that the Gilby Duvernay had merit. Our vision: build a strategic land position in part of the play that we believed had long-term potential. Several majors had accumulated Duvernay land positions in various parts of the province in previous years. The play was in its infancy. The optimal completions approach wasn't well understood, and costs were running in excess of $20 million per well. Several wells were drilled in the Gilby area. Notably, a number of wells were drilled by Encana and by Repsol. Many of these senior operators put a lot of money into the play initially, but they chose to move on from the play to focus more on mature and better understood shale plays within their portfolios. So in the first quarter of 2018, we did deals with Repsol and with Encana to build an initial position in the play. Jerry spent about $3.5 million to assemble about 90 sections of both freehold and Crown Duvernay rights in Gilby. 7 years later, on July 24, 2025, 3 sections of land sold at a Crown land sale auction for over $2 million per section. So even though this land purchase was extremely cost-effective at the time, there was an underlying reason for it. The tenure of the land was only 2 to 4 years. Near-term expiries were a very real thing. Realistically, the land needed to see proven production in the 2019 to 2021 timeframe to ensure both the freehold and the Crown lands could be continued past their primary term. To ensure that we extended our development timeline, we went out and spent another $1 million of our very scarce capital in late 2018 to drill a vertical stratigraphic test hole at 6 of 28, 42.3 West 5. And we performed technical testing on it to gather the rock properties from it. In 2018, Journey had 10,000 BOEs a day, mostly gas-weighted production. We had over $130 million of debt and an annual cash flow of less than $20 million. Our entire capital program was about the cost of one Duvernay well at the time. Yeah, we bought the land, but there was no board of directors or no bank that was going to let us spend $20 million on a single well event at that time. So we knew our lands were strategically located in a good spot. But nonetheless, farming out that land proved to be a bit of a challenge because the well completions and the cost structure had not yet been optimized for the play. So we shopped around. We spent about 9 months looking for a partner with experience in shale plays that could help us develop this resource. We farmed out the 90 to 100 sections to Kiwetinohk Resources Corp, KRC. At the same time, this was a team that had grown 7 generations, which is their previous company, to over 200,000 BOEs a day. So we thought that they had a lot of expertise in these type of plays. Deal closed effective August 29th, 2018. Journey was to retain a 37.5% working interest after the earning. So that gave us exposure to roughly 30 to 35 net sections. As part of the farm out, KRC then purchased lands that we had identified, growing the gross land position to about 140 sections. So we went from arguably 30 to 35 net sections post farm out to a high of about 50 net sections after these land purchases in early 2019. So at that time, The industry was just beginning to understand the real Duvernay sweet spot. And it was a narrow 10-mile wide band that ran parallel to the Rimbey-Leduc Reef Trend. And at the time, roughly 75 to 80% of our lands were within that ideal oil window. KRC drilled 3 Duvernay wells in 2019. These wells were expensive, over $17 million each. And they produced about 500 barrels a day of oil. At the time, these wells were considered competitive with other operators, but these costs were high. As the industry moved into a period of depressed commodity prices, followed after that by the COVID pandemic, it's no surprise that KRC chose to pivot away from the Duvernay in the Gilby area in favor of doing acquisitions of larger companies and larger asset groups. When they left, KRC had spent over $75 million on our joint lands at the time. Journey also had excessive leverage, as I mentioned, and that excessive leverage led to our own struggles during this same period. When COVID hit and prices collapsed, we had to hunker down, we had to stop spending money, and we had to try and survive as a going concern. In the meantime, our lands that were held by a patchwork of short tenure Crown and freehold leases began to expire. By 2023, our Duvernay footprint had shrunk dramatically. We went to 60 gross sections, which was down from a high of over 140. We went to 19.5 net sections, down from over 50. Most of these lands were 37.5% working interest lands that were held by production, lands that we had with KRC as our partner. So in October of 2020, Journey, along with AIMCO, was able to buy out our banking syndicate, which gave us a future. But having exited 2020 with over $90 million in debt, accelerated payments to AIMCO, Journey was forced to temporarily pivot away from the Duvernay, and we had to focus on building a stronger production base through our traditional buy and exploit business model. In 2022, we did a larger transaction where we acquired our flagship long-life Medicine Hat property from Enerplus. Once stabilized, we were in a position to start thinking again about the Duvernay at the start of 2023. As the commodity prices retreated in 2023, and now with debt payments to both AIMCO and Enerplus, we were again in no position to put brand new capital into the Duvernay. So instead of trying to hold everything, we had to focus on what mattered. We sold the less strategic lands in the north, and we recentered on the core. We took 100% of the proceeds from the lands we sold and we used them to release some previously held lands. So we now own up with about 20 to 25 sections of 100% lands, complemented by 15 or so sections of 37.5% lands that were held by production. By mid-2023, Journey controlled a clean, contiguous block of land, 30 to 35 net sections within a 50 square mile area, right in the heart of the play. 100% of these lands are in the sweet spot. That was not only defined by mapping, but that was now defined by the 3 wells that KRC drilled that were on production. And now we had significant tenure on these lands with no near-term expiries in front of us. So as part of this farm-in, we had committed to drilling 2 wells on the released land prior to 2026. So this meant that for the first time, we're facing first significant expenditures in the play. And we had to potentially expose the company to 2 higher cost wells. Of course, by this point, well costs had come down from over $17 million to approximately $14 million for wells drilled on 2 well pads. And Journey felt that our completions could be further optimized for the thickness of the Duvernay reservoir. Now, around this same time, things started changing in the basin, and the basin started consolidating very fast. Spartan Delta, who's now our current JV partner, entered the Duvernay in force. First thing they did is they purchased KRC, our former farm-out partner, and that made them our partner. They leased additional lands from Prairie Sky. They acquired Tourmaline's position north of us that they had picked up when Tourmaline bought Bonavista previously. They also picked up some Crown leases, and in doing so, they actually became one of the dominant landholders in the core of the play. That opened the door for Journey to become a strategic development partner along with Spartan. So in early 2024, we moved quickly. We developed a drilling and land strategy in February. Then we raised debt in March, and that was to compete in land sales, and it was also to drill new wells at our own cost. We entered into the JV with Spartan Delta in May of 2024, and as part of that, we committed to drilling the first 2 wells with them prior to the year-end 2024. So this joint venture now spans 128 sections. The partners control 112 of those sections, and Journey holds a 30% non-operated interest. Spartan's the operator with 70%. The key aspects of this joint venture are that right now we have no material expiry concerns. All of our acreage is within that oil window. We are aligned with a capable, well-capitalized operator that's allowing Journey to benefit from the economics of scale of being alongside a larger player. These lands are contiguous and the working interest is uniform, which allows us to more efficiently develop this resource. We've had further negotiations with the freeholder, and that's extended the tenure, and we've had further negotiations with the Crown, and that has enhanced our royalty moving forward. So from 2018 to 2025, we've come full circle. We had 90 to 100 sections, which is about 35 net. Then at the height, we had 140 sections, which was about 50 net. That shrank to about 15 sections held by production early in 2023, and now we've rebuilt it full circle to an undivided 30% net interest in a block of land where the partners control 112 sections with a clear runway for development. Again, that's now back to that 30 to 35 net section. So more importantly, all of this land was assembled with a cost of less than $5 million. That same property today, including the money that we spent on our capital, would be worth well over $100 million. That's not bad for a company with a $150 million market cap. It's the beginning of a new era of discipline and sustainable growth in the Duvernay. In the future video, we're going to cover the results of our 2024 and 2025 drilling and our future development plan. If you're following this story and you want real-time updates on our drilling progress, well performance, and our corporate milestones, head to our website. Sign up for Journey Energy's investor update list. We'll keep you updated as the results come in. Thank you for listening.